Have you heard of the company Arm? If not, you should. They're a UK chip designer that's been grabbing the headlines recently as their share price has absolutely rocketed. And although they're a UK company, they're actually listed in the US, which raises all sorts of questions. So, Sunil, first of all, can you tell us a bit more about Arm and why that company's grown so rapidly?
Well, you're right. It is interesting that this US stock market darling is listed in Cambridge, Cambridge, as opposed to Cambridge, Massachusetts. And of course, even here in the UK, they're not a household name, but they're a chip designer, and the microchips that they design are in virtually every smartphone in the world. Which obviously, gives them that real presence. Their ownership structure is interesting. So they're still 90% owned by SoftBank, which is an investment vehicle for an eccentric Japanese billionaire. They've owned their stake in the company since 2016, and believe me, SoftBank is probably one that we should do an episode on by itself. But back to Arm, since a 10% share of SoftBank's holding was listed back last September, the share price and by implication the value of the company has more than doubled.
I think we'll definitely be back to do an episode on SoftBank. It is also really, really interesting. But yeah, back to Arm. I mean, share price doubled. What's been driving that extraordinary performance?
Well, usually when you see those big increases in share prices, you're thinking this is a company that's in the right place at the right time. Well, I mean, one interesting thing about Arm is that it's been in the right place for a lot of time, in the sense that that started with the growth of smartphones. Remember, the first iPhone didn't come out till 2006. But then, obviously, since that time, they've been right at the forefront of the groove of Apple and Google and so on. But now we've been talking really recently about the big interest in artificial intelligence. Arm's technology isn't directly used for AI work, but companies like NVIDIA, which we've spoken about before, are using Arm chips to complement their AI-specific chips, so as part of the overall package. And it's not just NVIDIA. Arm still has that strong customer base in terms of those well-known consumer brands like Apple, and they're also seeing more and more demand from the Internet of Things, particularly the car-making industry and self-driving.
So they are in the right place at the right time, and I think they're actually founded back 30 years ago. So I guess they've been in the like you said, they've been in the right place at the right time for a really, really long time. But the other thing that really, really interests me about this story is the fact that it's a UK company, not in Massachusetts, Cambridge, but our Cambridge, and it's listed in the US. Listed on Wall Street. On the NASDAQ, which is where a lot of the US tech companies go to raise finance. So what is a UK company doing on Wall Street?
Well, they've definitely chosen to be a smaller fish in a big pond. I mean, if it had been a FTSE 100 company, it would already be in the top 5 biggest UK listings. But it isn't, of course. And I guess there's a couple of reasons for that. One is when the company was looking to list, everywhere you list, there's different listing rules and regulatory requirements, particularly around how much disclosure you give, how much control you can retain if you're the majority private investor. And ultimately, they thought they got the most favorable set of rules in the US. But the other key point is that the US is a massive market with really deep investor base, not just big companies, but even retail investors. And as a company, I think that gives you a lot more options in terms of where you might raise finance from in the future compared to other markets.
So this is going to be a weird analogy for someone that doesn't follow football, but I always think of the US equity market like the Premiership. It's well known and followed and recognised in the football world, and the US equity market seems to be similar. It's the Premiership of where you list companies. But it's huge though, isn't it? The US equity market now accounts for 60% of global market cap, which is huge. Is there a question mark over whether that's just too big?
Well, if you think about that deep investor base, lots of people who want to own shares, that's actually really always been a feature of the modern US economy. And so actually, if you go back to the late 1800s and just draw a line in terms of ownership, it's actually always been 40 to 70% of global share value market cap has been in the US, and it's averaged about 50%. Now, obviously, those companies themselves are super global, almost regardless of where they're headquartered. The revenue streams come from all around the world. So the US is a big market, but it's really a selection of global companies that wanted access to that really strong and deep US investor base. And, ARM is a perfect example of that.
It almost raises a philosophical question whether, when you think about the US equity market, should we even bother to think of it as a region anymore, given that it's really just seems to be more like a global marketplace where huge global companies that are integrated around the world seem to go and list to raise finance. Sunil, really, really interesting today. And of course, thank you for everyone for joining in. And we'll be back again next week with another episode.